I don't think there's that many more kind of hurdles anymore. I think, once you have enough kind of legendary investors come out, once you have a corporation added to their balance sheet, once you have an insurance company added, most of the floodgates are open.
Hello there from Bedford. How are you all? Welcome to the What Bitcoin Did podcast, which is brought to you by the mighty Kraken, the best place to buy, sell and trade Bitcoin. I'm your host Peter McCormack, and I've got my end of year macro review with the amazing Lyn Alden. But before that, I do have a message from my amazing show sponsors. So let's kick off with BlockFi, and a massive thanks to BlockFi for continuing to support the show. It's been over 2 years now they've been sponsoring it. We've stuck this out together, and I'm really, really proud and amazed of what they've done as a company. Now, they did have a big announcement recently. They are launching a Bitcoin Visa Rewards credit card where you can earn a market-leading 1.5% rewards on all card purchases. The waitlist registration is now open to all registered BlockFi clients, and if you want to join the priority waiting list, then you just need to open up a BlockFi account. If you don't want to, then the public waitlist is slated to open in early January, and if you're interested in checking BlockFi out, I do recommend you do your own research and then head over to blockfi.com, which is blockfi.com. Also, a massive thanks to Kraken for continuing to sponsor and support the show. Now, they are my favourite place for buying and selling Bitcoin, and they are the only place I use for buying and selling Bitcoin. And you want to know why, right? Well, Kraken is consistently rated the best and most secure cryptocurrency exchange, and security is really, really important to me. They also have a best-in-class in customer service. So if you've got any issue, whatever it is, wherever you are, if you reach out to them, they're going to help you get that shit sorted. And if you want to start trading Bitcoin, they have all the tools you could possibly need. So whatever your level of experience, at kraken.com, it could not be easier to sign up and start trading Bitcoin. They also have a beautiful mobile first app, so you can buy Bitcoin on the go. And with their margin trading, futures and OTC desk, Kraken has every option covered for you. There is no better place to trade Bitcoin. You can find out more at kraken.com or download the app. It's available for the iPhone and Android. Just search for Kraken Pro, which is KrakenPro. Okay, on to the show today, and I'm joined by the amazing Lyn Alden to review 2020 through a macro lens. Lyn has been on the show before, you will have heard her, she really, really killed it. There was so much great feedback about that, so when I was preparing to do a monthly macro review in 2021, I asked Lyn if she wanted to come on board with that, and she agreed, which is great news for everyone who likes her work, that she's going to be on the show every month in 2021. Now, in this episode, we get into what a crazy year 2020 has been, from the pandemic's effect on the economy, the crazy levels of money printing, and fears of high inflation, and how a scarce asset like Bitcoin stands to gain from this. It's been really interesting to talk to Lyn about all of this. It's always interesting talking to Lyn, and this one was no different. It was a great round up to the year. If you've got any questions about this show, got any feedback, you want to reach out to me, it's hello@whatbitcoindid.com. As I said, I always reply to everyone. As long as you don't send me some weird nonsense, I will get back to you. I might take a few days depending on when it is. Outside of that, have a great week, and I will see you all soon. Lyn, hi, how are you?
Good, how are you?
I'm really, really good, thank you. I think we're all good. What a week, right?
Yeah, it's been a crazy week.
I mean, I only care about Bitcoin. I know you have a diverse portfolio, but that's my only investment. So when I have a good week, I have a really good week. And when I have a bad week, I have a really bad week. But I know you're a Bitcoiner now, so you must have been enjoying this run-up. Did you expect it?
Yeah, it's a little earlier than I would have guessed, I suppose. So, one thing I've been covering since November is I was, cautioning people about a potential correction because we came pretty far pretty fast. We were testing previous highs. And I reiterated that I'm not trading around, that I'm not selling any Bitcoins and just kind of setting expectations. And so we got that correction, we got that consolidation. And then my main focus there was, once it breaks over 20,000, that's quite a run up potential. And so
Yeah.
until it breaks 20,000, it was kind of vulnerable to corrections. But then it just kind of out of nowhere just broke above 20,000 and kept going.
Kept going. Was it just short of 23,800, which I thought was pretty impressive. I think it'll be interesting to see if it stays above 20,000. If there's any pullback,
Yeah.
I don't know. I don't tend to look at what happens this time of the year. Are they still trading as much? What do you expect?
With Bitcoin, I don't know. I know that, general markets, people trade less, but, historically for, especially the U.S. stock market, they call it the Santa rally. So stocks tend to do very well into the year end. And so, we'll see if that ends up applying to Bitcoin or not.
Well, there's lots of interesting people coming in. Anyway, we're going to do a review of the year, so thank you for doing this. I really appreciate you coming on. Our last show did exceptionally well. It's been viewed over 80,000 times now, which is amazing. And we're going to be working together a little bit more over the year, which is also exciting. But we've got a lot to cover. I think realistically, the best starting point we're going to have to start with is the economic shock. The biggest, you called it the biggest in modern history. What happened this year? Just out of interest, when you call it the biggest in modern history, what kind of time frame is that? Is that like our lifetime, even our parents?
I mean, back to World War II, roughly, at least in a lot of countries.
Right. So definitely. I mean, it's the biggest I've known, and the
Yeah, at least
strangest.
as yeah, if you measure it as, for example, GDP decline, unemployment increase going up in the United States, and for most countries, I mean, their GDP was just absolutely crushed during quarter two. And so we've already had a sharp rebound. We still haven't gotten back to previous levels in most countries. And so, basically it's a bigger economic shock than the crisis from over a decade ago. And you pretty much have to go back to, the major wars or the Great Depression to find similar economic shocks.
Have you noticed any difference between countries which may have handled the lockdowns in a better way, like outside of people's opinions of whether lockdowns should happen or not? I'm not interested in that right now. Let's say, for example, the UK, we kind of have these tier-based systems. We've just been, where I live, been put into tier 3, which is like the highest level. The whole thing's been an absolute massive failure. And you look at a country like Australia, and again, I'm not judging how the strictness of their lockdowns. I'm just more interested in, have you noticed any pattern related to different countries, the economic shock?
Not in some of the really broad economic indicators. And so, for example, we can look at Japan, for example. In Japan, they never did full lockdowns. They had very low virus counts, but they still had a really big economic slump. And same thing generally applies to a lot of other countries. There's not a ton of correlation. It partially depends on how export driven the economy is, how commodity dependent the economy is. I think that certainly makes a difference when you get down to the individual small business level, right? Because those are the ones that are the most impacted by the shutdowns. And so that data is much harder to measure. But for example, in the United States, we saw a big drop off in small business activity. Then we started to see a rebound this summer, but then it rolled back over and it's just been kind of stagnant. And so that's actually my biggest concern probably of this whole crisis is that basically that the crushing of small restaurants, small businesses compared to a lot of the bigger companies being able to stay in business more comfortably, partially because they can access capital markets. Partially just because they have more financial reserves to work through, and also because they got bailouts. And even though we did, in the United States, for example, we did PPP loans that turn into grants, so that kind of went to keeping some of these small businesses afloat, but that only lasted a few months. And so if the shutdowns last a lot longer than the stimulus, a lot of them end up going out of business.
Yeah, I guess if you're someone like McDonald's, you can very quickly implement a no access. We had it here. There's no access to the restaurant, but you could use the drive-through. We know things like Domino's can very quickly set themselves up to be delivery only, and they have the ability to advertise this, reach out to people. I guess these, if you're a smaller, like a pub or an independent sandwich shop, in that kind of situation, firstly putting in the infrastructure, but also letting people know that you can do that is a lot more difficult.
Yeah, yeah,
Yeah.
absolutely.
All right, so let's break down what happened in terms of your kind of observations on how, and we'll use the US as a, that's the majority of the listeners to this, but in terms of what we've seen in stimulus from the government, what's actually been in place? What has the effect been? What's the impact?
So the stimulus in the United States took a couple different forms. One was $1,200 stimulus checks. They got a lot of the attention, but some of the bigger components of it were basically that the federal government provided extra unemployment benefits for people that lost their jobs. And so normally the way it works in the United States is that states provide unemployment benefits, and they're pretty small benefits. But this year, the federal government said we'll add another $600 a week to those unemployment benefits. And so that lasted 3 or 4 months. And so for people that got the full amount of that, that was several thousands of dollars. And in many cases, that exceeded the wages they were making that they would have made if they were still employed during that time. So we actually saw briefly national income went up in April and May. Yeah, then also they did PPP loans. These are basically several $100 billion of loans that went out to small businesses that are largely forgiven. So they mostly turn into grants as long as you met certain really basic requirements. But of course, we found out over time a lot of that was used for fraud. It disproportionately went to kind of medium-sized businesses, not even really super small businesses. It was kind of scaled up, and a lot of that went to some of the bigger small businesses, if that makes sense.
Mm.
And then, since then we've been, a stimulus mostly tapered off, and now they've been negotiating another package that might be 900 billion, it might be another number, and so far they've been unable to kind of come to a consensus. It looks like they're getting closer. Probably, maybe when this airs, it'll be, we'll have news out, it'll be different. But basically, there's been such like an economic hole, and all the stimulus going back to try to fill it up, and so we're seeing a really rapid increase in the broad money supply and the national debt.
And what has the impact of that been? Because like the things that I look out for are very basic, but and some things you highlighted to me, for example, that despite companies closing down for business for temporary periods and the massive impact on GDP, we have seen this massive rise in the stock market despite a huge increase in jobs. It doesn't make sense why this is happening, but what's your analysis?
So part of it I think makes sense and part of it doesn't. And so if you separate growth stocks from value stocks, right? So most value stocks like, banks and other things like that, they had a much worse time throughout the year. And only in recent months did they really kind of start to recover pretty strongly. Many of them are still below their early 2020 or late 2019 highs. Whereas tech stocks, growth stocks, most of them just soared all the way to new all-time highs. And in some countries like the United States, those tech growth stocks make up a big chunk of the index, and so they can pull the whole index up really sharply. And so we've seen that kind of bifurcation between companies that are not harmed by it and that were harmed by it. But then because interest rates came down so far, that cash, in many places is negative nominal yields, and then the United States, even if you're getting a zero or a slightly positive yield, it's still not keeping up with inflation, and so you have a negative real yield. And so basically, investors are seem to be using stocks as a store of value. They're saying even though some of them are highly valued, even though they're risky, one of the alternatives is cash that literally takes your purchasing power away. And so and that's like, for example, Michael Saylor pointed out, he was sitting on, hundreds of millions of dollars in cash while the broad money supply is going up, 25% year over year, and likely to go up in not to that extent, but double digit percentages, probably for several more years. And so when people see that happening, they'd rather be in equities.
Right. One thing I wanted to understand is that traditionally people invest in stocks. Usually, you should be investing in stocks based on projections of how that company will do and forward belief. But we've also seen a massive increase in retail investors with apps such as Robinhood. I'm guessing that if there's a number of new buyers coming in, I'm going to hazard a guess that these people aren't as experienced in knowing what to trade, how to trade, reading cash flow forecasts, reading projections, looking at the competition with the market, and maybe are just buying a little bit more based on, I don't know, gut feel. And therefore, does that just traditional supply demand mean that there's too much demand for those stocks and that's inflating the prices?
Yeah, pretty much. And we haven't really seen this type of retail enthusiasm since the late 90s during the dot-com bubble,
Yeah.
because we never got this during, in the aftermath of the 2009 crisis, for example, when the stock market started to recover, we never saw that enthusiasm come back. And whereas we have to go back pretty much to the late 90s to find, a lot of indicators look similar. So back then, the amount of IPOs was very high, and the majority of them were unprofitable. Something like 80% of them were unprofitable. And of course, there was a frenzy of retail buying. That was, of course, like not long after the creation of the consumer internet, and so the availability of online brokerages really took off. And so, we had that big kind of lull where there wasn't a lot of, retail activity. We saw more passive investing. But then this year, I mean, I guess people, they couldn't really go out in many cases. They got stimulus checks. And so people just poured into, all sorts of trading programs. And so they basically, flooded into stocks. But then even institutional buyers they're looking at the available options, they're looking at interest rates, and they're still saying I'd rather be in equities. I think it depends on the sector you look at. So I think some of the tech stocks got really overvalued, but there are other stocks like healthcare stocks or other sort of equities that are still average valuation compared to their history, and so they still look more attractive, for example, than cash, because you can buy a healthcare stock. It might have a price to earnings ratio of 15, which is normal. It might be paying a 2 or 3% dividend yield, and it's growing earnings, compared to holding cash in a bank that is paying you like 0.2%, and then inflation's like 1.5%, and you're just getting your purchasing power chipped away, while broad money goes up at 10, 20% a year.
Yeah, I don't know who's getting 0.2%, but I'm not getting that in my bank, that's for sure. Do you worry about something like Tesla? Because the company's now valued more than, isn't it, like all other car companies put together? And do you worry that we could be heading to a similar kind of dot-com crash that happened in the 90s? Could something be trigger that?
I think some of those sectors have gotten into bubble territory. And so, like, if you look at some of the mega caps, like say, Google and Amazon, they're expensive, but they're not like, comically expensive relative to their, kind of, their cash flows, their earnings. There are some stocks like Apple that I think got quite ahead of themselves. But really, to find the most kind of bubblicious ones, it's a lot of the unprofitable tech companies. The price to sales ratios look a lot like the late 90s. And, in particular, we've seen a really big boom in renewable energy this year. And it's funny because the fundamentals aren't that different than 12 months ago, but their stock prices are in many cases up, double, triple, quadruple, or in Tesla's case, more than that. And so, and now that Tesla is being added to the S&P 500 index, roughly right now, like it basically, investors are already kind of putting that in now. And so that kind of created a lot of forced buying because all these major index funds have to buy Tesla now, and it's the biggest component ever added to the S&P 500. And the reason that happened is because in order to be added to the S&P 500, you have to be a profitable company. And Tesla spent most of its lifetime not profitable, but it got so big anyway in terms of valuation. And so I think Tesla and some of the other, renewable energy stocks, some of the unprofitable tech stocks, some of them are vulnerable, in the years ahead to, I think, a pretty sizable correction.
Right, I'm just looking. The Tesla market cap is right now $620 billion, and analysts expect revenue of 8.3 billion, 8.4 billion. We've reported net income of 331 million. Pretty wild.
Yeah, it's outrageous. Yeah, it's an extraordinarily high price to sales ratio, and it's tricky because a lot of people point out that they're not purely a car company, and that's true, but they're still, yeah, I mean, they're a big chunk of what they do is hardware, whether it's cars, whether it's solar things, whether it's batteries, things like that, and hardware just traditionally does not have super high profit margins.
Mm.
One of the exceptions is Apple. The blend of hardware and software. They've been able to have really high profit margins, but in general, it's just a very competitive business, and we see a lot of other top automakers like Porsche and other other big names kind of come into the electrical vehicle space, and so I consider Tesla to be a pretty high valued risk stock. Now it's one of those things. I mean, this has been a funny year because anyone who had any sort of prudence, anyone who's saying looks expensive, generally throughout the year, whatever you were looking at just got more expensive,
I
and
know.
so it's been tricky definitely for people that are trying to risk manage anything. But it's one of those things that can go further than you think. But whenever it does reverse, it can get pretty scary.
Would you dare short it?
So I did a couple. I wouldn't do like one of those like long-term shorts on it because you always have the risk of it going up. I've done a couple attempted shorts on Tesla for fun this summer, which is basically that if it starts to have a correction from very overbought levels, I'll put a small short position on, but then with a very tight stop, so that if it goes up, and breaks a certain level, like it breaks new all-time highs, I cover my short and get out. So I basically lost no money on it, but one of those times it could pay off pretty substantially, and so I use it as a minor hedge sometimes if I want to, because I have Bitcoin, I have equities, I have all these other investments, and so occasionally when we have overbought conditions, I look for a small hedge. But you have to be very careful with when you do that. Those investors that have just been kind of holding a short Tesla position, I've just gotten crushed.
All right. Well, listen. Let's get back to what's been happening with the economy this year. So you said to me in like your notes, because we spoke beforehand, you said to me that this isn't like a normal recession. What is the key difference, and how do you think we will come out of this?
So with most recessions, basically you get a big decline in economic activity, you get a big deleveraging event, and you get a big stock market decline. So people lose a lot of net worth on paper. This one, because we're towards the end of a long-term debt cycle, which is a subject we talked a lot
Yeah.
about in our previous podcast, that basically things work different in this sort of environment in the sense that usually it's a rapid increase in the broad money supply because basically the amount of debt is so big in the system that if it were to deleverage, the system would kind of unravel and become insolvent. And so what you see instead is that you see partial deleveraging here and there, but then you also see a rapid increase in the broad money supply and some degree of currency devaluation. And so the fact that we had the biggest economic shock in history while average incomes went up is an example of that. And so and the stock market hit fresh new all-time highs while we had the biggest economic shock since World War II. If you also look at things like the amount of sovereign debt issued both in the United States and around the world is just absolutely immense. It looks basically like a war. You have to go back to World War II again to find times where fiscal deficits as a percentage of GDP were this high. And so it's a very different environment than the normal 5 to 10 year recession.
Yeah, actually, that was something I wanted to ask you, but that I didn't really understand. Is that I understand how the UK and the US can essentially switch the money printer on. How do they do that in the EU when they have a single currency? How do individual states?
Uh, Yeah, that's actually, I mean, that's what part of the reason they've done in some cases smaller stimulus because they have to do something as a consensus.
Right.
And so kind of like in the United States where we have so much polarization between, red states and blue states and, a lot of political gridlock that, makes things hard to get done. Europe in many ways is more extreme in that sense because you have to get buy-in from multiple countries. And so neither of those individual countries can just unilaterally do a massive fiscal stimulus because they gave up control of their own currency. Whereas for example Japan, the United States, Britain, they all have just more unilateral decision to basically devalue their currency and prop up whatever they're trying to prop up.
So does that mean the euro is a good currency to hold right now? Is it holding up better against the dollar and the pound and the yen?
Ironically, yes. I mean that the Europe has. I haven't checked it versus the pound, but the euro has been very strong versus the dollar this year. And that was actually one of my, I've been outlining that probability ever since late 2019. That I've been in basically the camp that I think that the dollar was going to decrease versus a basket of major currencies, and that basket is dominated by the euro in terms of market cap. And so that has happened so far this year pretty sharply. And it's partly because Europe just has not done the same level of fiscal stimulus as the United States. And so, their currency held up stronger, but some of their economic indicators have been weaker.
Yeah, that's interesting. I'm just looking now. Back in March, essentially when it started, it was trying to follow this. Yeah, it has dropped. Not sure if I'm reading this chart correct. It shows why I'm well out of my depth. But it does look like it's dropped. That's interesting. Quite a big drop as well.
Yeah, like late last year, it was worth, like a €1 is worth $1.11.
Yeah.
And then we had that big volatility event around March,
Mm.
but then now, the euro is worth $1.23.
Yeah,
And
that's
so
amazing.
it's had that, yeah, something like a 10% appreciation. And so
That could
that's been
continue
my
as well,
base
right?
case. Just potentially, it's getting up near some resistance levels, and so if you look back, we had similar weakness in the dollar back in 2017 into the very beginning of 2018, and we're kind of retesting those highs. And so it'll be interesting to see if it can break that level or if it kind of gets range bound here. My base case is probably over the next several years to see the dollar weaken versus a basket of major currencies, but we have to watch some of those key levels.
Well, they're all going to weaken against Bitcoin, that's for sure. Right. Okay. So listen, you were talking about the increase in the broad money supply by about 20%. Just so people understand, just explain what the broad money supply is.
Yeah, so there's a couple different ways to define money. It's funny because we think of money should be simple to define, but it's actually there's multiple ways to define it. And so uh, banks, for example, have base money. So base money consists of things like the reserves that banks have, on deposit with the central bank. And base money also includes things like currency in circulation, physical currency. But then there's a much larger amount of money that consists of checking accounts, savings accounts, certificates of deposits, things like that. If you were to like look at all your fiat bank accounts, that's part of the broad money equation. And in the United States, that figures something around 19 trillion. So there's about 19 trillion if you add up checking accounts, savings accounts, currency in circulation, all those different metrics. And so that figure has gone up about 25% year over year. And if you look back over the past decade, it was rising at maybe 5 or 6% a year on average. And so this has been the biggest jump since the 1940s. And that's a lot different than, for example, what happened in 2008, 2009. So when people often look at what central banks are doing, like they're increasing their balance sheet. A lot of that QE that they do when they increase bank reserves, a lot of that does not get out into the broad money supply. That only gets out into the broad money supply if either banks lend it or if the government runs massive fiscal deficits and basically ejects it out to people. They give people checks, they bail things out. And so we saw that on a much smaller scale back in 2008, 2009. But in this year, both in the U.S. and to a lesser extent in other countries, that combination of massive quantitative easing combined with massive fiscal deficits basically injected that money straight into the broad money supply.
Right. So when you talk about potential new stimulus bill, not say not, let's just say for the sake of ease, say it's another $1 trillion. Does that increase the broad money supply by $1 trillion?
Generally, yes. But it depends on a couple of specifics. And so, if we were to go back, say, before we got into all this craziness with central bank balance sheets going vertical, generally, if the government were to do a fiscal stimulus, so it pays the money out, but then legally it has to issue bonds to basically recoup those expenses. It can't just print money and send it out to people. And so they would basically extract money from somewhere else. So they issue bonds and then investors buy those bonds. So that extracts capital from them and then it injects that capital to other people. And so in that sense, you would not see a broad money supply
That's kind of
increase.
zero sum, yeah.
You're just rearranging where the money is. However, if they do a massive fiscal stimulus and then when they issue the bonds, the central bank just prints money and buys those bonds, then that money is not really extracted from anywhere else in the economy. And of course, there's all sorts of legal things like that. The central bank generally doesn't buy directly from the Treasury. It's like banks will buy it and then they'll sell it to the Fed, like at another time. And but one way or another, they end up on the Fed's balance sheet with newly printed money. And so when you have that combination of massive fiscal stimulus with massive quantitative easing, that directly increases the broad money supply.
So 25%, you're talking about 4 to 5 trillion increase this year.
Yeah, something like that. Yeah.
Holy shit. Okay. So the implications of that are, how does that tend to trickle out into the economy? What tends to be the implications? Because I've read a lot about a lot of the money just ending up making rich people richer. There's a lot of people complaining about that's essentially what's happened here. It's gone to essentially the billionaires and the people running the companies. But where does this tend to kind of trickle out to?
So if you look back historically, again, looking at the United States, we over the past century, we've had two very inflationary decades. Those were the 1940s and the 1970s, and both of those were also the two decades that saw a very big increase in the broad money supply. And so basically we're on track where broad money supply increases over the past several years, especially because of this year, are starting to look like those decades. Now,
Right.
we've not seen the official consumer price inflation tick up to that level yet. And there's a variety of reasons for that. One is because a lot of people couldn't spend during this year, right? They could spend on things like, home goods or, they had to kind of target their spending. They couldn't travel as much. They couldn't eat at restaurants as much. So that money didn't circulate very well. So we got a decrease in money velocity. And so it partially depends on how that stimulus is done. So if hypothetically, if they just had all the money go out in the form of stimulus checks or things like that, that would get out to the regular person, pretty significantly. And in part, that's what happened. But because also part of the money was used for corporate bailouts, part of the money went to, the high end of small businesses in the form of PPP loans. Like I know there are literally financial asset managers or research firms that got PPP loans that turn into grants. So they were doing fine, then they got money, it turns into grants. And part of the reason, like PPP loans were supposed to support the employees. Like
Hmm.
if you otherwise would have to fire employees, this says, okay, you get this money, but then you have to use that mostly to pay employees. But if you were not really planning on firing employees anyway, and then you still got the check, that all just goes up to senior management. That just goes up to whoever owns the company, unless they decide to give it out as bonuses or something. And so, because part of the stimulus went to those kind of upper echelon groups, and part of the stimulus went down to the everyday people, it's kind of a mixed bag.
So is there potential then, as we come out of lockdowns and people have their vaccinations and life gets kind of back to normal, that there may be an inflationary shock as people have sat on money? I know myself. Look, I can't spend any money at the moment. I can't travel, can't have holidays. I've saved money during this period, but I do know once it ends, we're going to have a holiday. Might buy a car. All those kind of things. May move house. Can you have an inflationary shock as there's a sudden, rapid increase in the circulation of money? Is that a possibility?
Yeah, I think so. And part of the reason we didn't see any sort of official inflation this year in a broad sense was because you had that big increase in the money supply that was offsetting that big deflationary shock.
Yeah.
And so if you alleviate that deflationary shock, I mean, that money's still out there forever. And so if that money starts to move a little quicker, it's pretty easy to get an inflationary shock. And there are a couple of things, for example, because we had a big decrease in energy prices this year. So energy prices are one of the big components for inflation.
Right.
And so because we had that kind of took away a lot of the inflationary potential. But then, of course, because commodity prices and energy prices became so low, we saw a lot of oil and gas companies start to cut their capital expenditures. So their production over the next several years is now lower than it would have been. And so if you get that rebound in travel, if you get that, basically that rebound in energy demand, up against tighter supply, then you can get higher energy prices, and that would likely trickle out into broader inflation. And so I think that's one of the key things to watch for is what happens with energy markets. So I think there's a decent chance that by late 2021, maybe 2022, you definitely could see some of that pent up demand as it relates to travel. So far this year, we know there has been targeted inflation. And so, for example, grocery prices in many countries became very elevated because we had to kind of rearrange our supply chains. We had some shortages, and if you look back in general, even though this has been a quote unquote uninflationary decade, there, official inflation measures have not been very high. It really depends on what segments you look at. So, for example, in the United States, for example, things like tuition or childcare or healthcare services, they've been quite inflationary. They've been going up at a much faster rate than the official like broad CPI. But that's been somewhat offset by things such as electronics keep getting cheaper. Offshoring keeps manufactured goods very cheap, and so there's been this big kind of bifurcation between manufactured good price increases versus service price increases. And so,
Right.
if you were to get that commodity shortage, you could have a broader inflationary surge.
Next up, I talked to Lyn more about macroeconomics and Bitcoin during 2020. But before that, I do have a message from my amazing show sponsors. All right, sportsbet.io, a big thank you to you as well for supporting the show all year. It's been great to work with you. I love this company. I love how much they care about Bitcoin. I love the fact that they put a Bitcoin logo on the front of a Premier League football shirt. If you get to watch Southampton this year, you'll see all around this. Actually, with Arsenal as well, you'll get to see all around the stadium sportsbet.io Bitcoin adverts, which is pretty cool. Now, sportsbet.io are the best place for online gaming because they do accept Bitcoin, which is pretty cool. And if you like gaming, they have markets for everything you could possibly be interested in. All US sports, all football, Premier League, Spanish football, Italian football, they've got everything covered. And for new customers, they always have a range of promotions available. Just head over to sportsbet.io/promotions, which is sportsbet.io/promotions. Okay, lastly, we're going to talk about my friends over at Casa who absolutely crush it with Bitcoin security. Now, with the market booming, with Bitcoin hovering around the $26,000, $27,000 mark, which in itself is slightly mental, but with it around there, some of you have probably seen your Bitcoin stack grow to quite a decent level, and you're probably thinking about your security. Now, with Casa, you're going to have a multi-sig setup, which is going to protect you from hacks, personal mistakes, in-person attacks, device failure, and so much more. I signed up 7 months ago. I became a paying customer. I didn't even take it for free like Nick offered it. I paid. I'm glad I paid for it. I've got so much peace of mind. Now, if you want to become a Casa customer, if you want to check it out, they do have a product for every Bitcoiner. They've got Casa Gold, which will give you triple the security of a hardware wallet. That one is only $10 a month. If you want to go a bit more premium, they've got Casa Platinum, where you get their 3 of 5 multi-sig, which is the best protection for large Bitcoin holders. That also comes at a great price. And with Casa Diamond, you get their full service offering. That includes a customized personal security review, inheritance planning, and of course, they're best in class in security. There is no better time to upgrade your Bitcoin security and get total peace of mind. You can find out more at keys.casa, which is keys.casa. What happened with inflation during the 40s and the 70s? How bad did it get? And add to that, how bad do you think it could get? What kind of rates do you think we could see?
So that it depends on the country you look at. In the United States, which is where I have my most detailed numbers, the 1940s and the 70s, they had similar levels of overall inflation, but it took different forms. So the 1940s, they had three really big spikes of inflation. And so, like the highest spike, I mean, two of the spikes got into double digits, and one of the other spikes got into the high single digits.
Wow.
And so they were just these rapid spikes. And so by the end of the decade, if you were holding treasuries, you lost something like a third of your purchasing power. If you look at the 70s, it was different because the high point, again, it got into the low double digits, but the high point was not quite as high as some of the spikes reached in the 1940s, but it was more persistent because it was kind of uncontrolled. Back then, it got in, but by the end of the decade, you lost about a third of your purchasing power if you were holding cash or treasuries. And actually, more than that, is one difference was that the 70s they were able to raise rates to try to combat inflation, whereas the 1940s they did not raise rates because sovereign debt was too high. And
Right.
so I don't have it partially is going to depend on what happens with energy markets and commodity markets. But I do think that there's a chance to get much higher inflation than the Federal Reserve's 2% inflation target.
So this is why all the billionaires are moving their money into Bitcoin, because essentially they could. It seems like they're front running the potential for inflation towards the end of next year. And
I think so. I mean, I think smart money is cautious. I mean, for example, if you look at Stanley Druckenmiller's comments, I mean, he's one
mm,
of the best traders in history. His returns were just absolutely silly, and so when he got into Bitcoin, he cited inflation as one of the reasons. He expects gold to do well. He says if gold does well, he thinks Bitcoin will do even better. He thinks some commodity companies could do pretty well, and so he's looking several years out, and so he cited, for example, like a 5-year outlook for his inflation concerns, and so it's one of those things that might happen late 2021, might happen 2022, but I think that the deeper you get into the 2020s decade here, with such rapid money supply increases, if you get any sort of commodity scarcity, that triggers a good potential for inflation.
yeah, I've got the Paul Tudor Jones letter that went out to his investors. I probably shouldn't have this, but I've got it anyway. And he refers to the great monetary inflation. Is this the term people are using? Have you
Well, I
heard
mean, yeah,
this?
I have not heard that specific term, but it's appropriate term just because it
Yeah.
hasn't been seen for decades.
I mean, it says in here, enlisting all the instruments that might respond to the great monetary inflation, the May investor letter postulated that one day Bitcoin might become the fastest horse in the race. He's actually very interesting. He's got all the different measures like Nasdaq, bunch of things I've never heard of that you'll know about. Um, GSCI, the Australian, I think that's an
Commodities.
Australian. It's like commodities, the yield curve. But he sees Bitcoin as the best asset and the fastest horse in the race with this. So it feels like what we're seeing with Bitcoin right now is that it's a race to get in because we saw what happened with the price it's doubled since Saylor did here. So if anyone wants to do what Michael Saylor did, it's going to cost them double what it cost him. It's a real like first come first serve with this. What did you make of that? Also, what did you make of MassMutual?
Oh, that's interesting just because, like a tech company doing it is different than a really established insurance company. And so the fact that now insurers are getting involved now, of course, for them is a much smaller percentage of their assets, is a fraction of 1%. But basically, that opens the floodgates where insurance companies could have a non-zero Bitcoin position, and so that represents trillions of dollars of capital. And if 1% of that gets into Bitcoin, I mean that can move the price around the world. And so it's one of those things where that individual purchase was not very significant, but if that represents the beginning of a consensus, that's pretty interesting. And it's funny because a lot of insurance companies don't even invest in stocks. And so if you look at a lot of insurance company balance sheets, it's mostly bonds and really super kind of low volatility investments. And then some of them also venture into equity positions. Berkshire Hathaway, Warren Buffett's company. I mean, that's primarily an insurance company, and they invest in equities, obviously. And then, there's other firms like Markel or one of the Ohio-based insurers. Some of them go into equities, but a lot of them are bonds only. And so to see, this one just going to Bitcoin is pretty interesting.
Are you more bullish now on Bitcoin?
I about as bullish as I was this summer. So I started my position in April and I was, pretty bullish. But by the time I got to the summer, I was extremely bullish, and so I kind of have that same level of quite bullishness.
You're not wishing you just put all your money in Bitcoin this year. You're not thinking, damn, that was the one trade.
Just it's just not how. Yeah, I don't put
I
all
know
in. I
you
have a
don't.
pretty sizable position though.
I
Yeah.
read your reports. Your how long do they take you, by the way? Each one's like a book.
They take several hours to do, but research goes into it ahead of time.
Yeah.
And I mean, some of my public articles, like my recent one on the global dollar reserve system, I mean, that one was one of my longest pieces ever, so that took days to put together.
Hold on, was that the one you sent me?
No, that one, the other one, that
Oh,
was actually the
the
one I
money
sent
printing
you,
one.
the
Yeah.
money printing one. That was also one of my longest, so that took a long time, and in part because it was partially aimed at educating retail investors, but it was also kind of a response to some other professional investors because there's been a lot of debates lately about what exactly constitutes money printing, and so that was kind of a response to some of them to kind of lay it out and say like here's the mechanics and to basically kind of a counterpoint to some of the arguments I've been hearing.
Well, what does constitute money printing, and what are the myths? Where are people getting it wrong?
So there are basically people saying that because quantitative easing does not get out, into the broad money supply, that it doesn't constitute money printing. And I agree with that part. But I think what a lot of people were missing is if you do quantitative easing combined with massive fiscal deficits, that injects it almost one for one directly into the broad money supply. And I
Okay.
think there are a lot of people kind of missing that extra variable.
Okay. Okay.
Because if you go back to 2008, a lot of people saw those balance sheets go vertical and they were calling for hyperinflation, and of course we never got that. It was not a very inflationary decade, and that's in large part because they missed the fact that there was no mechanism to get those bank reserves out into the broad public. So it was not lent by banks, and deficits, while they were sizable, they were not huge, and so we didn't see a rapid increase in the broad money supply after the global financial crisis, despite all of the central bank balance sheets going vertical. But so a lot of people are saying basically that it's going to happen the same thing this time. Quantitative easing is not inflationary, and I'm saying okay, that's fair, but look at what broad money supply is doing because this time is a different matter than 2008, 2009 because that's getting directly out into the broad money supply.
So if somebody was listening to this, Lynn, somebody, yeah, a bit like myself, and they're thinking, right, crap, I don't understand all this, but I'm nervous. What are the things that people should be looking out for? Because whilst we've had all these warnings, everyone's been warning us about the money printer, everyone's been warning us about inflation, but like you say, things are quite steady at the moment. Here in the UK, we aren't seeing massive inflation. We just aren't, and yet our government is borrowing more money than they've ever borrowed. What are the things that people should be looking out for, and when would you think they will start to notice, an impact on their personal income or savings, I should say?
I would focus on probably energy prices.
Okay.
Watch what oil is doing, and if you're going to watch another indicator, watch what broad money supply is doing. And if you look at, I mean, several countries, if you look at most countries in the world, their broad money supply has not gone up as rapidly as the United States. So if you look at, a lot of places in Europe, if you look at China, if you look at Japan, their money supply might have gone up, say, 10% year over year, which is pretty significant. In some cases, a little bit more. But the United States has been one of the exceptions where we've gone up 25% year over year.
Yeah, you talked also about the signs of recovery, and you talked about a quick V rebound that rolls over into a flat grind. What do you think is going to be here? Is it because there's certain companies that can rebound quickly and there'll be access to capital, but there are other industries that perhaps have been almost decimated?
Yeah, pretty much. And so, if you look at previous, if you look at the 2008 recession, if you look at the 2001 recession in the United States, it took several years to get back to full employment. So, not just in terms of the unemployment rate, but in terms of the number of people employed. And so a lot of people earlier this year were calling for a V-shaped recovery. They were like, as soon as the lockdowns end, I mean, this is back in March and April. They were like, as soon as the lockdowns end, jobs can go right back up. We'll get back to normal. And I was pointing out that's not how it works. You can't just have millions of people leave the labor force and then quickly go back, because what you have is you have a full credit cycle play out. So you start to have insolvencies. You have thousands of restaurants just go out of business and close their doors. You have some of the more cyclical businesses, companies that make products for restaurants, companies that make that are associated with travel. A lot of them just go bust, and so those people never get back to their job. And so what I called for instead was I called it a backward square root sign recovery, which is you get that snapback in
Yeah.
jobs, right? So you get that mini V because lockdowns end, restaurants go from being all closed to like partially open. You get that kind of quick snapback, but it's only part of the way, and then it rolls over and goes mostly sideways, and then it takes years to get rest of the jobs back. And so far, that's exactly what's been playing out, where now jobs are growing very, very slowly in the United States and many other countries.
So could we be in a situation where we've got slow job growth, high inflation, and the government being out of bullets essentially with both fiscal and monetary stimulus? Sounds like a disaster scenario.
So potentially. Now, part of it is that part of the reason why some people aren't worried about inflation is because if there's high joblessness and if wages don't really rise, right? Because there's a lot of workers looking for jobs, so they're not really in a position to negotiate for higher wages. That can potentially keep a lid on inflation, right? Because you don't have
Right.
more and more money chasing more and more fewer and fewer goods. Now that can be short-circuited if you get massive fiscal stimulus to just kind of pace people anyway, and then if you get some sort of commodity shortage. And so I think those are things to watch is what happens with stimulus and what happens with energy pricing. Now, in terms of running out of bullets, I mean, monetary policy is mostly out of bullets now. I mean, they're all like near zero, some cases below zero. And so they're pretty much limited to asset purchases, kind of monetizing whatever the fiscal spending is happening. And so fiscal stimulus is they can pretty much do that until they get inflation, but then the genie's out of the bottle, right? So I think that's kind of what we're seeing now is that because they're not seeing inflation, they're just like, well, let's do more. And so you can keep doing more, and it seems like there's no kind of cost for doing that. And at first there isn't because it's offsetting a deflationary shock. But then if you were to alleviate some of those deflationary conditions, either because people are traveling again, or energy demands back, or as commodity scarcity happens, and you're still getting those pretty sizable fiscal budget deficits, I do think that creates a more inflationary environment, while the
Mm.
economy is potentially still pretty weak.
Yeah, it's interesting because you referred to classic fourth turning stuff, and it's only a book I've recently come to know, and I'm kind of working my way through it, and it's kind of prophetic, really, that is what we're going through here, and it feels kind of scary, really, because of the implications of what a fourth turning means. We discussed it, I think, at our last interview. I think I mentioned I'd been out to Santiago in Chile, and there was massive inequality there, and it seems like these are issues that seem to be affecting other markets, and can affect here in the UK and in the US. An increase in people unemployed and an increase in crime. It's kind of scary.
No, yeah, it's definitely. I mean, I can't imagine how, especially for people that couldn't work from home this year. I mean, imagine the anger a lot of people felt when their restaurants was closed. Either they owned the restaurant or they worked at the restaurant, or they worked in travel, and so a lot of people are just experiencing a lot of economic pain this year. Basically, it's at the situation where there's so much kind of bifurcation between, some places did very well throughout the pandemic, other places did very poorly, and so there's just a lot of frustration build up, and it also goes country by country. So, for example, in the United States, if you look at the median net worth of the person, it's actually lower than the median net worth of most European countries or Japan, basically most other developed countries. And so there's a lot more economic vulnerability here for people that if they lose their paycheck, especially also because they can potentially lose their health care. And so it's just been it's around the world, especially the United States and but many countries around the world, it's just been an extremely kind of difficult time for people to go through. And so yeah, if you go back to the fourth turnings, it's just always a very kind of challenging event where existing institutions get challenged, right? So more and more people stop listening to kind of the establishment authorities and start kind of wanting to do their own thing. And so, some people, for example, I think you had Brandon on your podcast who linked the fourth turning to Bitcoin. And so Bitcoin's kind of a classic fourth turning response, right? So it's saying, the people are just going to do their own thing if they don't like how governments or central banks are handling things. And so we've seen this kind of big interplay between, some of these more decentralized forces versus some of the centralized forces.
Yeah, and we're in this position now, which is there's like this crossover I'm doing where I'm kind of working my way through the fourth turning and the sovereign individual, whereby we do have this escape valve where people do have Bitcoin, but also have the ability to move, and this kind of like regulatory arbitrage where it's a thing that Balaji talks about that's really interesting is that there's you can vote with your you can vote with your ballot, with your feet, and with your money, and right now the vote with your feet is the most powerful vote that you potentially have. The mass exodus of people out of San Francisco into places like Austin and Miami is super interesting, and I'm kind of intrigued on what the impact that is going to have. I don't know if you're tracking any of that.
Yeah, because that's a key risk to watch out for because as those states, that have people move out of them, they lose tax revenue. And unlike the federal government, they can't just print money to fund themselves. And so they basically have to end up, say, cutting police, cutting, whatever their state workers might be. They have to cut costs, and then that can, create potentially, less safe conditions, can potentially, less infrastructure spending, things like that. And so you kind of get that vicious cycle where then more and more people want to leave. And we saw, if you look back in, New York's kind of high crime days in the 70s and 80s, we saw some of that
Hmm.
happen there, where just like a local government can spiral pretty quickly. And so, we talked before about how European countries can't kind of unilaterally print a lot of money. They can't because they don't control their own currency, and it's a similar phenomenon with U.S. states. And so they're these big economies. They have a lot of they have pension debts to their public workers. They have all sorts of things, and so one of their only release valves is they have to cut workers. They have to raise property taxes, and that creates a less desirable place to live. And so you can potentially see some crisis situations play out. I mean, there have been some U.S. cities that have been absolutely devastated due to offshoring. So if you look at, for example, Detroit,
Hmm.
or due to a lot of the small cities around the Midwest, a lot of them have just been devastated over time by jobs leaving, and then it just kind of becomes a vicious cycle. And so there are a lot more cities that are vulnerable to that.
All right, well, listen, we can't finish without touching a little bit on Bitcoin. There's a couple of things we need to cover. Obviously, very, very interesting time. We've touched it a little bit at the moment, but it appears that Bitcoin is becoming obviously a more interesting option for a range of people, from the billionaires to the hedge funds to even the insurance companies. In terms of like consideration for next year, do you think this is just going to continue to grow? Do you think there's any particular hurdles for other investors yet to now come into Bitcoin, or do you think the likes of Paul Tudor Jones, the likes of MassMutual and Square MicroStrategy, do you think they've essentially created the kind of protective moat around Bitcoin for people to invest?
Yeah, I don't think there's that many more kind of hurdles anymore. I think, once you have enough kind of legendary investors come out, once you have a corporation added to their balance sheet, once you have an insurance company added, most of the floodgates are opened, right? And so at that point, I think the biggest thing is, there will be some investors that say, well, like I wish I bought it at 10,000, but I don't want to buy it at 20,000.
Yeah.
But then, it goes up to a little higher, and they're like, well, I'll just buy it. And so there's that kind of some people will be hesitant to buy it, but then it can cause FOMO in the other direction. So when they finally give up and just buy it, then you get a price spike. And one thing that's different now is that, because there's more institutional buy-in, some of these, holding periods could be a lot longer. And so when you have a lot of Bitcoin be accumulated by the Grayscale Bitcoin Trust or accumulated on kind of a more institutional balance sheets, there's a good chance that's not going to be sold within a year, for example.
Yeah,
And
long,
so
long time holders.
yeah, and actually, if you look at the 2017 bull run, and this is actually one thing I've been a little bit surprised by, is if you look at that run, it would become overbought sometimes on the if you look at relative strength index and other metrics like that, it would become overbought, and then it would kind of correct 20%, kind of relieve some of that pressure, and then keep going up from there. But this recent few months. It's just been kind of a building to a higher and higher weekly relative strength index, higher than levels we reached in 2017. And I'm basically watching to see, are we going to finally have that kind of brutal correction and then keep going up from there? Or is because it's more institutional, is it kind of just going to go up, a lot further than people think? And so one of the kind of the risks of, a lot of people always want to wait for a correction to buy in, right? But then, it can always surprise to the upside too, right?
Yeah.
So that's why, for example, I've been, kind of managing expectations of my readers, but also saying I'm not trading around it. Like I'm not, even if I expect Bitcoin to correct 10% or something like that, doesn't mean I'm selling it to try to game that. I'm just kind of saying I already have my position. I think dollar cost averaging makes sense. And people just have to kind of be aware that when it gets overbought, don't be shocked if you were to get a correction, but it's not guaranteed.
Well, as ever, Lyn, it's always fascinating talking to you. You're like a encyclopedia of macro knowledge. I always feel a little bit smarter, then also a bit dumber after talking to you. But no, it's super helpful. I love talking to you. It looks like it's going to be a great year for Bitcoin next year. Very excited. Appreciate you coming on. Looking forward to making lots of shows with you next year. And I wish you a Merry Christmas.
Yep, thanks for having me. Merry Christmas to you too. And we'll see how the rest of this year plays out. I'm hoping that by 2021, things start to return a little bit more to normal.
All right. I know you love that one. I don't even need to ask. How good is Lyn? She's amazing, right? I'm really looking forward to these shows next year. I think it's going to be a great way of keeping on top of everything that's going on throughout the year, definitely from the macros perspective, because it affects us all. Now, the schedule is a bit all over the place right now. Firstly, there's been some important shows I needed to get out, like the one with Coin Center the other day. If you haven't checked that out, please do go and check that out. Some important work that they're doing over there. I also want to get my end-of-year review with Matt Odell out, but that's probably going to have to come out on Thursday now, literally the last day of the year. Anyway, next week, everything will be back to normal, back to my normal Tuesday, Friday release schedule. Just want to say big thanks to everyone who supported the show all year, really, not just on an ongoing basis. Whether you're a guest, a listener, someone who tells their friends to check the show out, a sponsor, you're all amazing. I couldn't do this without you. So I hope you've all had a great year yourself. I know it's been a bit weird, a bit fucked up for us all, but I hope you've somehow had a good year. If you want to help the show, I always just ask for reviews on iTunes. They really help with the listings. It takes about 2 minutes. If you want to do that, I will massively appreciate it. Outside of that, have a great week, and I'll see you all on Thursday.